Well, thank you so very much for having me at this conference. It's a great privilege to discuss economics and market economics and power markets economics. Do you guys, can you see my screen on your screen? Is that good?
Yes, it's perfect. Mm-hmm.
Excellent. Well, to tell you the truth, one of my first assignments as I was finishing my PhD, I worked for a semester at the World Bank in Washington, D.C. And one of my first assignments was coming to Brazil. That was in the spring of 1997. And I came to discuss with people at the ministry in Brasilia, people at Eletrobras also. We came to discuss market opening. So that it's a pleasure for me to talk again to people from Brazil. Of course, it would have been better to be physically in Brazil, but it's kind of going back to where I come from, and I have very fond memories of working with the people in Brazil and discussing with them. So 20 years later, what do we know about electricity reform? And what I'd like to share with you is two things: is what we have learned. It's been more than 20 years now since we restructured the power industry. And the first point is, what have we learned? What are the lessons? What has worked? What hasn't worked? And try to answer, or at least give a perspective on some of the really important issues that Richard was presenting in his introduction. So that's the first one. And the second one, I'd like to share with you where we view the industry as heading and the new challenges that we are facing. So number one, what we have learned. We've learned that electricity matters, which you all know, but a bit more specifically, this is every time I start talking about the electricity industry, I think it's very helpful to start with this quote from Lenin, which I think highlights the importance of electricity in the 20th century. Electricity was the big the second industrial revolution. It's because of electricity that we saw a lot of growth, economic growth in the 20th century. So that's the first thing. The second thing, which is really important, is that electricity is a very political commodity. And that we need to bear that in mind as we think about the way we structure the industry, as we think about markets, as we think about planning, as we think about prices, price levels. Electricity is a very political commodity. It's not just any commodity. And I think Lenin had it right when he said that electricity matters. So that's the first point. Second, when you look at the power industry over the last 100 years or so, you can divide it in three parts. The first part, which we call the golden age, was the age of regulated monopolies. So that would be Petrobras Electrobras, in Brazil. That would be EDF in France. That would be Enel in Italy. Those would be the large state-owned utilities that deliver power to the citizens. In the United States, the utilities were mostly privately owned, but they were publicly regulated. So those were regulated monopoly that were operated under a franchise. So what we had is a vertically integrated structure, and we'll talk about the golden age because things were simple then. From the 1990s to the mid-2000s, we start introducing markets in the power industry. And that's the second phase where we replace the vertically integrated structure with markets, and we replace the dispatch room of the vertically integrated utility with the spot price as a signal for dispatch decisions. The third phase, which we are getting into now, which we are actually into now, is the return of regulation. And I date that from mid-2000s to today. You could say it's a bit earlier, you could say a bit later, but clearly today we have a return of regulation. And there are four factors that I think explain this return to regulations. The first one is the California power crisis that really shook belief from policymakers in the potency of markets. The second one is the 2008 financial crisis, which I think had a massive impact on the way citizens view markets and the way the society at large view the performance of markets. Then we have the energy transition and the renewable support that started in Europe in the mid-2000s that came to overtake markets and suddenly to collide with markets. And finally, over the last 3 to 4 years, we see a lot of issues about energy security and also energy affordability. So those 4 factors came to transform the electric power industry, and they shape the way we think about power markets. So that's the 3 phases. I'm going to go over each of those phases very briefly. The golden age, I won't spend too much time on it. This is a power system. There are large economies of scale in generation. For most of the 20th century, the race was to build bigger power plants, be them coal-fired power plants, nuclear power plants. In Brazil, it was the dams, the bigger dams, you get economies of scale. So you get large companies building those things. The distribution and the transmission grids are natural monopolies. There will be only one grid in Brazil, and in each city, there'll be only one distribution company. So those are natural monopolies. And then there's some gain from vertical integration because it's good to plan at the same time the grid and to plan the generation assets. So the basic structure was that of vertically integrated monopoly. We had that virtually everywhere, be them state-owned or privately owned but regulated. So that's the structure. And what you had at the time, and I want to emphasize that, was a very clear and predictable pricing structure. So I give an old example. It's from the United States. It's 1992. This is one of the last years where we had clean data like that. And what I want to show you is that if you are a vertically integrated utility in the 1990s, in the early 1990s in the United States, you know exactly how much money you're going to get. You're going to get $71 for every megawatt hours you're going to be selling. And you rate the price you're going to be able to receive for every megawatt hours you sell, covers your cost. It covers your cost of generation, but also your cost of network, client services, administrative, and so on and so forth. A couple of points which I think matter. It was the case then. The numbers are about right, and they haven't changed that much, even though the industry structure has changed. Generation usually is a bit more than half of the total cost of delivering power. You think about half, a bit more than half in most countries. Networks is about, a third. In that case, it was a bit lower in the States at that time. Distribution is about twice the size of transport. And then client service was very small at the time, but now you get some of the overhead expenses. So that's the structure: vertically integrated, predictable rates that are discussed and negotiated with the regulators. And that goes up until about 1990. And then in 1990, 2 things happened. First, technology changes. There's a massive introduction of new technologies. One is information technology. That is, you have now big computers that are able to replicate the dispatch of the vertically integrated utility, but in a competitive context. So you can have a computer that optimizes the bids from hundreds of power producers and determine the mates order and dispatches the plant. So it's no longer manual, it can be computerized, and that opens the possibility of organizing markets for power. And that insight actually can be found in a very old book, 1986, written by Paul Josko and Dick Schmalenzy at MIT, where they say, because essentially of computing power, we can have market for power now, which you couldn't have had earlier. So one innovation is information technology. The other innovation, of course, is combined cycle gas turbines. They are cheaper, they are cleaner, you can build them smaller. And those 2 innovations are necessary conditions for a change in the industry structure. A second condition, and I insist on that because it really matters, is the changes in politics. When you look at the history of political thought, the end of the 70s is the disappearance of communism and the eruption of liberalism, what we call neoliberalism in most of Europe. And essentially you have Reagan and Thatcher that replaced Lenin as the guiding thought. So the idea being at the onset of the 80s that markets are better at allocating resources than bureaucracies. And the objective, the purpose of the restructuring of the power industry that took place in the 90s is to unleash market efficiency. When we came down with the World Bank to Brazil, the argument was you have a great power company, Eletrobras is doing a great job. Maybe if you open to competition, two things will happen. You'll be a bit more efficient because competition drives efficiency. And second, there'll be more innovation. And by opening markets, by opening the power industry to markets and to competition, by creating those markets, we expect to have a bit more efficiency, but we also to expect to have more innovation. So that's what we're looking for in those markets. So that's the situation. 1997, we do that. We go from vertically integrated utility. We essentially do three things. We separate the networks, which are regulated infrastructure, from production and supply. We create competition in retail market, and we create to manage the interface between generation, which is competitive, and production and supply, or retail, which is also competitive. We create a wholesale market. That's what we have in most of the United States and in most of Europe, different institutional arrangements. But the idea is that as a customer now, you can choose your supplier. Your supplier or your retailer will be able to buy the megawatt hour on the wholesale market. So either they will produce them or they'll buy them on the wholesale market or compete on the wholesale market to buy the megawatt hours. And on the other side, there will be competing producers that will sell their megawatt hours into the wholesale market. So that's production and supply. And then you're going to have regulated network businesses, transmission and distribution, which remain regulated monopoly. So that's what we did from 1990 to up to today. Now, the first question I want to address is what have we learned? Has it worked? What have we learned? And there are good news and bad news. And I'm just going to first give you the highlights, and then we're going to go into some of the more detailed issues. The first one is that it's working. The lights have remained on most of the time. And it may sound obvious, but the biggest, when you look at the biography of Margaret Thatcher, one of her biggest worries when the regulation of the power industry started in the United Kingdom, which was the first country, actually, was in England and Wales, the first country to deregulate the power industry. Margaret Thatcher was very concerned the lights would somehow not remain on. And we've seen the lights have remained on. That there are accidents, there are blackouts, but we cannot attribute those blackouts to the market opening. So we had a big crisis in New York in 2003. We had a crisis in Europe shortly thereafter. We had something in Texas last winter, but we cannot say it's because of market opening, it's because of restructuring that we had those crises. Those are bad events that were poorly managed, but this is not the result of competition. So by and large, the lights have remained on. So that's good news. We've seen a lot of investment in generation, and that's also good news. In the UK, the coal-fired power plants have been replaced by gas-fired power plants. That happened very early on in the 1990s. So you've seen new entrants. In the US, we've seen new assets coming online, and on our chart that will show that to you later. So there has been new entry, and then sometimes it has transformed the generation mix. In Europe and in North America, we've seen a lot of entry by renewables. So those have been subsidized, but the new entrants have often been new companies or new businesses or new business lines of existing companies. So in a way, opening the market on the upstream has delivered on its promise of new generation and new entrants. So that has somehow worked out. Another good piece of news is that after what was a disastrous start in California in the summer of 2001, there's a way we can manage market power. As you know, as soon as you have a market, you have concerns about market power. It's the case in every industry. It seems now that we are in the power industry able to control market power, and we have not had, since Enron in 2000, 2001, we have not had massive market power issues to deal with. So that seems to be working. So that's good news. The bad news, and there are two bad news. One is that for the customer, nothing has changed. You still have a supplier, so you have multiple suppliers to choose from, but essentially your suppliers offer you the same thing as they did before, which is megawatt hours at a fixed price. And that we haven't seen any massive innovation in retail. I remember when I was starting to work in the 1990s, it was very exciting, and we were expecting new retail offers. We're expecting that people would come to your house and say, look, I'm not going to offer you electricity. I'm going to offer you heating. I'm going to offer you lights, and you're going to pay as a function of how much heat you want in your house and how many working hours you want to have in your house. And you're not going to buy megawatt hours. You're going to buy something different. We were expecting all those kind of offers, and nothing really has happened. So that has been a big disappointment. And it has been a disappointment for economists, but mostly it has been a disappointment for citizens who say, well, look, you've done all that, you restructured the industry, it's become a bit more complicated for me because now when my lights are out, I don't know if I need to call the power supplier or maybe I need to call the distribution company. You've made this thing a bit more complicated for me, and I don't see much benefit. So that's one of the big disappointments. And the other big disappointment, although it is very good for economics professor, is that when you open the black box of the vertically integrated utilities, in fact, you open a Pandora's box, and all of a sudden there are all those complex rules. And Richard was alluding in his introductory remarks to some of those rules. There's all those complex rules that come out that have to be thought after, solve problems, and day-ahead markets and ancillary services and this and this and that. And then it becomes exceedingly complicated. And before it was handled by the utility, nobody knew what they were doing. They had their own rules. It was working fine. And now we have to get that into the open, and we have to make a lot of design. And it's truly to be very complicated. Again, it's very good for economic professors. It's excellent for economic consultants. It has generated thousands of hours of billings. But I don't think it's very helpful in general. So good news and bad news. Now, when you take a step back, and I think it's important to appreciate those factors as we think about the power industry. I think, when I look at myself, when I came to Brazil 25 years ago to talk to the people at Electrobras and talk to people at the ministry, those are the things I wish I'd known. I was a kid back then, right? So I can be forgiven for that. But those are the things I didn't know, and I think if I'd known them, I would have been better off. First, we underestimated the engineering constraint and the characteristic of the system. A power plant is not a plane. A plane, when you open the airline industry to competition, planes, you put them here, you put them there. You have to be very careful about the safety of the operations of the plane, but in a way, it's an easier system to manage than a power network. Power network, you have unit commitment problems, you have ramp up, ramp down, you need to have operating reserves, you need to keep the voltage at every level, at the same level, every hour, in real time. There's a lot of constraints that we've forgotten, and a lot of characteristics that I think make it very different from other systems and other industries. And I think we underestimated that. The other thing we underestimated is the stickiness of habits and cultures, both in the power utilities employees and in the customers. I'll just give you an example to illustrate. I think the guys at the power company, and certainly that's the case in France, and it's the case in most power companies I've known to, they have the view of the way the system should work, and they are not they're not very eager to change. And let me just give you an example. Before I was working at EDF, I was teaching power markets to EDF employees, and those were managers and high potential, the high flyers of EDF. So I'd go them and tell them about prices and balancing markets and this and that, and explain to them how it works with a little game, and it was really good. It was good fun. So we do that, and then at the end of the day, we'd go for drinks and dinner, friends. So it always has a dinner at the end, and people drink a bit. And when they're a bit, not tipsy, but when I've drank a bit, they come to me and they say, well, Professor, we understand what you tell us, but really, it was better before, right? And, I just spend my time telling them, well, and that's how power, it was better before. And I could tell them the story I wanted, and they just felt in their guts it was better before. So there's something that we underestimated, that it's really hard to transform companies. And it's really hard to get guys who are engineers steeped in running power networks and tell them now all of a sudden you're going to be traders and you're going to do things different. So there's some thing we underestimated. And we also underestimated the stickiness of customers. Customers, at the end of the day, they don't really care. All they want is their power to come out of the plug. And we had this view that, they're going to embrace dynamic pricing, and they're going to do this, they're going to do that, and they want power that's branded, and they want green power. At the end of the day, they don't really want that. So I think we completely underestimated that. We also underestimated the political sensitivity. Whenever something happens to the power industry, the politicians are just up in arms. And I have a story that I like very much. It's David Cameron, which was the Prime Minister of the United Kingdom. So here's a guy who walked the United Kingdom into Brexit. So he had no qualms about it. The referendum is just willing to gamble the future of Great Britain and the future of, to a certain extent, the European Union, the European projects on a referendum. So that's the guy who's really, really confident. And then one day there's a blackout in the United Kingdom, and the blackout lasts for one afternoon. So it's no biggie, right? It's a one afternoon blackout, and there are maybe 1 million people that are stranded, and customers cannot go back home, and the trains are blocked. And all of a sudden we get all panicky and convene a massive regular ministerial committee and a lot of excitement about one blackout. I understand a blackout is bad. There are people who got stuck in their trains, but it's 1 million people for half a day. It's nothing compared to the Brexit decision. So that, for me, illustrates the political sensitivity of power markets. And there are great examples of that. I'm sure in Brazil you have the same. So when we look back, we forgot about all those things. And the other thing we forgot is that those factors are not the same in one country or the other. So, for example, the Brazilian system, which is very hydro-based, like the one in Canada, the work in the Nordic country, the work in New Zealand, has different physical and technical characteristics than a thermal system that we have in most of the United States or that we have in most of Europe. And trying to apply the same rules to a hydro-based system and to a thermal system is not going to work. And we have to be cognizant of that. And I think we were not cognizant of that at the onset. Another mistake we made is we took the independent regulator model and applied that everywhere. I remember coming to Brazil and telling them, well, you need to have an independent regulator because that's the way to do it. And I just, people were looking at me saying, well, we don't really know what it is. I mean, we don't have that experience. And when I came back to France, the French people tell me, well, look, we have a strong state. Our state knows how to do stuff, but we don't know how to do independent regulation. It's not in our culture. It's not the way our institutions were set up. And I know the French institutions, they were set up over 1,000 years of French kings and French republics. They are not set up to have independent regulation. This is not the way our civil service works. And we fail to see that, and we fail to take that into account. So that's what we've learned. Now, more details going into some of the issues. So when I want to talk about upstream, and I'm going to talk about upstream and downstream, about upstreams, I want to talk about one way to structure the conversation is to talk about the free horizon of supply security. People talk a lot about energy supply security, but they confuse, I think, three different things. One is what is really energy supply security. How many terawatt hours of energy you have for the coming years. And usually it's measured in joules or exajoules. And that's a strategic issue that's best handled by governments. So let me just give you an example. In Europe, starting from the 70s, we had a lot of natural gas. In the North Sea, were tons of natural gas that were pumped by the Norwegians, a bit by the Swedes, plus by the United Kingdom. So we had energy security plenty because we had our natural gas, it was ours, and we could burn it and use it to produce power or to heat the houses. Today, we have no more natural gas. Our natural gas comes from Russia via pipelines, or it can also come from the United States or from Qatar, from the Middle East, via mostly LNG terminals. So we have no more energy security. And in the fall, a couple of weeks ago, it has started a couple of months ago, but it's up until now, there was no more gas in Europe. The price of gas went up. The price of electricity went up. Everybody's up in arms. And there's a lot of political tension and political crisis. And that's about energy security because somebody forgot that we need a steady supply of gas and that we do not have any more gas. So that's a big issue for Europe. And as we think about the power sector, one of the key questions we have to ask ourselves is where is the primary energy? Where are the primary fuels going to come from? Are there all own fuels? Or are we going to depend on neighbors? And if we depend on neighbors, how many neighbors we depend on? What's the competitive landscape? So that's a big deal, energy security, that we forgot about, but that's really important. I don't think it's a big issue for Brazil because you guys have hydro, you can have sun, wind. So I don't think you worry too much about energy security. But for us Europeans, it's a big deal. And then there are two other issues, generation adequacy, which is measured in gigawatts, and our systems reliability, which is measured in gigawatt per second. So there are three different issues that we need to worry about when we think about market. Energy security, I like those pictures because those are the guys that guarantee energy security for me. Trump is gone, but the other ones are still here. So when I think about my long-term supply of gas, those are the guys that are going to either produce it or buy the gas, China is competing with us to buy gas. So that's my landscape as far as energy security goes. Generation adequacy. So that's a good one. That's a good one because I remember when I was writing my PhD, nobody was really focused on generation adequacy. People said, well, you're going to have spot prices, and when the spot prices are going to be high, people are going to invest a bit more because they'll anticipate that spot prices are going to remain high. They'll be running models, they'll see high spot price, they'll see a profit opportunity, and they'll enter in the power industry like we do in every other industry. And that's the bakery example. If the price of bread goes up, people will say, well, maybe we can create one more bakery, and then there'll be one more bakery and the price of bread will go down. Or you can do that with hotels. I mean, that's competition for you. So I remember writing my PhD and nobody was really focused about generation adequacy. And in reality, of course, we have political and engineering fear of blackouts. And those are legitimate fears that have led to capacity mechanisms. And we've had capacity mechanisms in one way, shape, or form for the last about 20 years. It started in the early 20s, in the early noughties in the US, and have been going all over. There's been complex design. There have been lots of mistakes, growing pains, design faults. And you've seen that for many, many years. And we're learning, I think in New England, there are 7 or 8 generation of capacity mechanism. In France, we have a capacity mechanism and we redo it every so often because it's not the right design and discover faults. Now I'm going to give you, this is my opinion. That's why I wrote it in blue. There's a lot of debate among academic economists about generation adequacy. Some people think some capacity mechanism is required. I'm in the minority that think I'm not sure it's required. I feel markets can balance themselves. And I'll caveat that by talking about the future when we need to have decarbonization of the industry. But I think for the last 20 years, I think we have created complex institutions for no reason. One thing I'm sure of is that it's a self-fulfilling prophecy. So if the policymakers and the regulatory authority says, we have a problem, we're going to create a capacity mechanism, we're going to intervene in market, then investors, seeing that regulatory authorities are intervening in markets, are going to be very concerned about investing. They will not invest, and then you will need to have government intervention. So in a way, there's some sort of multiple equilibria. You have one equilibrium where markets function on their own and governments do not intervene, and you have another equilibrium where governments intervene in one way, shape, or form, and then government must intervene, otherwise it doesn't work. So that generation adequacy in the past. I just want to share with you the most important chart in power economics. That's the most the only thing we need to know about power economics. So that's the basic, and I'm going to explain to you how that works. So you have the standard economic chart of capacity on the horizontal axis, prices on the vertical axis, and the demand curve is a downward sloping blue curve. And you have different demand curves, one for every hour of the year. On the left, it's a low demand hour. In France, that would be the night in the summer. On the right, it's a high demand hour. That would be in France, that would be the evening, the late afternoon in the winter. And you have installed capacity K, and you have only one generation technology, which has marginal cost of production C. The basic pricing structure of the industry is that as long as demand is lower than generation capacity, the price is set at a variable cost. That works for a thermal system. Brazil, it's mostly hydro. It's different because it's about the opportunity cost of power. It's not so much a variable cost, but the story remains by and large the same. As long as you have more capacity than demand, it's set at a variable cost. When demand is equal to capacity, the price is set by the value of the last unit consumed. And that's a very old insight, actually. It was derived in 1949, which is a long time ago, by Marcel Boiteux, which was the chief economist of EDF at the time, which was one of the greatest economists of power markets that we had. And that duality is very important. That applies to a lot of commodities that are non-storable. When you think about a hotel room at the beach, and I think people come to Brazil all the time, so I'm going to take a European beach where people go only for the summer. In the winter, nobody goes at the beach, and they will sell you their rooms at the variable cost. They'll just, you'll pay very cheap for the room. In the summer, they'll raise the price of the room, and what will set the price will be the willingness to pay, will be the price that people are willing to pay for the room, and not the cost of running the room. And that's also the case in power market. And that's really important to understand. Now, why does it matter? Because when you look at the pricing structure, you see a lot of hours when the price is low, but you see a few hours where the price goes up, and all of the profits are in those hours. The shaded area are the operating profits. And the power industry is an industry where the profits are made in very few hours during the year. Maybe 100 years during the year is where the profits are made for most technologies. So that's a very particular industry for that. Now, in the long-term equilibrium, and that's theory. In theory, they say, well, look, people are going to compute that expected profit, and when that surface is higher than the cost of building a new plant, they'll come in. And if the triangle is lower, they may reduce their plan. So we believe that markets will balance themselves. For markets to balance themselves, you have to have a bit of demand response. And I've done the math here. And you can show that you don't need a lot of demand response to have a natural equilibrium in markets. And depending on the parameters you choose, if you have 20% of your demand that responds to prices, you're good to go. The market balances itself. You don't have curtailment. And you can hope that the long-term equilibrium is going to work. So that's why I'm not convinced about capacity mechanisms. I think the market can handle itself. But again, I must confess, I'm in a minority in my profession. And most academics, and of course all consultants, think that somehow the capacity mechanism is required. Now, what do the facts tell us? And those are data from the United States from 1990 to 2008. The blue line is the investment, the installed capacity, that's the summer installed capacity. And the red line is the reserve margin, which is the installed capacity over peak demand. And what you see is typical, it's a boom-bust cycle. So that the shape goes down and up and down and up of the red line, while it's a boom-bust cycle. It means that in the 90s, there was uncertainty, regulatory uncertainty. People did not invest much. Then in the late 90s, you open up the market, the price go up, people invest a lot, and they all invest at the same time. Reserve margin shoot up over 20%. And then there's too much capacity. Demand grows, not much investment. Reserve margin shoot down back to 12%. And then we are in 2006. Reserve margins are down, prices are up, and you invest. So my view is that if you let the market do its own thing, you'll see boom-bust cycles. So you'll see periods of high capacity, too much capacity, low prices. People are going to limp a bit for a while, and then it's going to take care of itself. But again, that's my view, and others have different views on that subject. So that's for generation adequacy. The last point was about system reliability, and here we have a very nice solution that was developed by Bill Hogan in 2005. That's a known solution, but it's called co-procurement of energy and reserves, which is that when you have, and that's what they do in Texas, that's what they do in many states in the US. So essentially, the system operator buys the demand. So that would be the black line, which corresponds to the demand. But he also buys in the market the reserve. So they say, I'm going to buy the demand plus the reserve. So I'm going to co-procure demand plus reserve. So I'm going to buy all that. And demand, I'm going to pay the euros per megawatt hours. The reserves, I'm going to pay them only if they are turned on, if they are cold. If they are not cold, I'm going to pay them the price, the market clearing price, minus their cost. So I'm going to pay them something like an opportunity cost, as if they had run, but because they are not running. So I'm going to pay them the market clearing price minus their costs, because they are not really spending the cost. So they're just going to get the profit. And that seems to be working fine in Europe. In the United States. In Europe, we have other mechanisms which I think are more cumbersome because you buy your reserves in different markets. It feels like that's the most elegant and the most practical solution to operating reserves. Again, with the caveat that it works in a thermal system, I'm not sure how it works in a hydro system like Brazil. So that's the past. The last thing about the past is talking about downstream customers. And essentially, we found a couple of things. Three things. One thing is that large users benefit from retail competition. So the company I work for, EDF, we have a large customers unit, and they really, the customers, the large units that buy from us are very sophisticated. So they make us compete against other suppliers. They make us price every option we give them and every option they give us. This is exceedingly competitive. And for those guys, market opening has been good because they've been able to gain better terms in terms of their power markets and the power purchases. So that's been successful for the large users. For the retail customers, by and large, they are not interested in their electricity bill, and they are not interested in their electricity supply arrangements. They're not interested in changing customers. So the biggest surprise was the stickiness of customers. And that's something we found in Europe, North America, in New Zealand. I was in New Zealand a few years ago, and they were desperate from the stickiness of customers. There are tons of academic papers, tons of experiments. People, by and large, people don't want to switch. I mean, you have a minority of people who are the young one, highly educated, tech savvy. They like to switch. They go on the internet, they compare the offers, and they switch. But it's a minority of people. Most people actually remain with their historical supplier. They cannot be bothered. And it is true that by remaining with their historical supplier, they leave a bit of money on the table, maybe $100 a year. But that's the way people are. And we were expecting more competition, but in fact, we see less interest in competition. Retailers, as I said before, they have not done much. When I started my career, I worked as a consultant for McKinsey and Company. It was really fun. That was a German firm. They said, "Oh, we're going to compete on brand, and we're going to sell branded power." They had a brand called Yellow. Maybe some of you are old enough remember Yellow. And they say, people are going to buy our electricity because it's going to be yellow. Well, people don't care, really. I mean, they just don't care. They couldn't buy yellow. They couldn't care less. And then retailers, they try to compete on price, but the retail margin is so little that, you compete on $10 a year for customers or $20 a year for customers, or let's say $50 a year for customers. It's too little. I mean, it just doesn't cover the cost of getting the customers. So it's not, I think not much is happening in retail. And that, as said, was a big disappointment. One thing we learned, and I think that was alluded to by Richard, is regulators need to do macro prudential regulation of retailers, the same way as banks. Why? Because most retailers, they buy power on the spot market to sell it to their customers. So the spot price is very volatile. And as the spot price is very volatile, retailers can get bankrupt very quickly. So it's very important. The regulators, they do prudential regulation. So they ask the retailers to show them the hedging structure that they put in place. So if you sell power to a customer on a long-term contract, fixed price, that's fine. How much of that long-term sale is hedged in forward market? How much fixed price power do you have bought against what you have to sell? And that's very important. It was done in New Zealand. It's anonymous. It's, the same way the bank disclose their positions to the regulators. The power retailers need to do that with the regulators. The regulators need to ask them that. If you don't do that, you get into trouble and you get a lot of bankruptcy. In the UK, I think there were 8 or 10 bankruptcies since September because the spot price has gone up a lot. So a lot of retailers got bankrupt, and that creates a lot of havoc. You have to get somebody to stand in for the existing retailers. There's billing issues. It gets very complicated. So that's something we didn't know and something we need to take care of. What's facing us, and I have a few more slides on the challenges ahead. The biggest issue of our time is global warming, and I'm not going to dwell on that, but the IPCC reports are very clear. If we get to 2 degrees, which is probably where we're going to get to, there are lots of places in the world where it's not going to be fun. So when you look at central Brazil, it's going to be between 2.5 and 3 degrees more. It's really not going to be fun. Africa is going to be the same. Most of Europe is going to be the same. It's going to be very uncomfortable. And that's a big issue we're facing. We know how to solve that issue, and that's the math behind the last IPCC report. Those are different trajectories that the IPCC people have simulated. One trajectory where we continue to emit, that's a very high, and at the bottom one, a trajectory that's very low. So if we do very low, which is net zero by 2050, we're going to get about 2 degrees, between 1.5 and 2 degrees around 2030 to 2070. But then we're going to go down below 1.7, which is which is not good, but which is fine. If we don't get there, the more likely scenario is the low scenario, but not the most likely. The feasible scenario is the low scenario. So we get to net zero by 2070, and we get to 2 degrees, which starts to be hot. Anything else is bad. I mean, whenever we get to 3 degrees, it's going to be very, very bad. Why does it matter for us? Because that's now the big challenge for the power industry. When you look at the power industry, it's no longer about competition. It's no longer about efficiency. It's no longer about innovation. It is really, really, really about producing more electricity and getting it low carbon. So my time is up, so I'm just going to show you a couple of things, and then I'm going to close in 2 minutes. The first one is some work that we're doing at EDF about distribution of failure. The blue bars and dots are failure today, and the maroon one, the brown one, are failures tomorrow. And what I want to show you is that the power system of the future with a lot of variable renewables is going to be very different in terms of failure distribution than it is today. And that's very important to understand. The power system of the future will have a lot of renewables and will behave very differently from the power system of today. Last point, there's a tension between short run and long run. In the short run, you have to have a very volatile prices to give the short-term signal for demand response, for storage. So you want a lot of short-run price volatility because that's going to drive real-time efficiency. But in the long run, short-term price volatility is really bad because it increases the cost of capital. So that's a problem. So the next market design, and that's my last slide, is how do we reconcile the need for short-term price sensitivity with the need for long-term investment incentives. So there's something about long-term contracts, and people are working on those long-term contracts, and it's a very hard problem to solve. It's a very active research question. We don't have the answer yet. But what I want to let you with is the challenge of tomorrow is about decarbonization of the power sector. That will have dramatic impact on the way the system works. And that will require a new market design that will most likely involve some long-term contract to balance the need for short-term price signal and the need for long-term investment decisions. And I'm done. Back to you.
Ok. Professor Léautier, muito obrigado por sua apresentação. Excelente, pelas relações que eu já estou recebendo aqui. Extremamente proveitosa para todos nós. Eu vou passar a palavra agora para o Eduardo Monteiro, que vai, nosso diretor executivo, que vai conduzir algumas perguntas diretamente ao senhor, chamando a atenção do nosso público que no canto superior direito da tela tem lá a possibilidade de fazer perguntas pelo chat. O que o Eduardo vai fazer aqui é compilar essas perguntas e endereçá-las ao professor Léautier. Temos aí 10 minutos de perguntas.
We have 10 minutes of question and answers here. Eduardo Monteiro, please.
Hi, Professor. Thank you again for your time.
You're very welcome.
I can tell you the audience is having fun with your statements here.
Thank you.
So I'm trying to bundle all the questions into categories. So the first one, that's sort of the most popular one, is one that I could classify in the structural, institutional, even philosophical arena. Okay, you mentioned that energy is power. Energy is very subject to political forces, political emotions sometimes. So if we accept that as reality, and we think about regulation as the tool to solve all sorts of political interference into this very politically sensitive sector industry or market, which is electricity. What do you do when the politicians themselves try to disrespect or even to ignore regulation whatsoever? Right? And I don't mean to be too abrasive, I don't mean to be even opportunistic, but we're living today in Brazil this sort of dilemma when high authorities, they look at regulated markets or even sort of competitive markets and cannot accept by any means that they cannot control the prices of fuel, of oil, and electricity. So what's your reaction to that? You mentioned that you lived in a country with this sort of cultural tension, given the role of regulation and power. Do you have any suggestions? Should we give up? And as a second degree question, do you think that this reaction of the politicians is due to the fact that regulation became too complex, too complicated for the politicians and even for the public to follow?
That's an excellent question, and we have the same. I just want to reassure you, we have the same thing in Europe. We have it's not a Brazil thing; it's a worldwide thing. I'm just going to give you an example, and then tell you why I think it's happening and what we can do about it. The example is in France, in Europe, the gas price has shot up. So the electricity price has shot up because the price is set by the marginal cost of the last unit producing. Usually it's a coal-fired power plant or gas-fired power plant. And the price has really shot up. And in most countries, there's some sort of link between the retail price that people are paying and the forward power price. So the retail price is going up for people, and people see their bills going up, or they anticipate that their bill will go up, and all of a sudden politicians are up in arms. Now, in France, the French economic minister, so the Minister of Economy, is saying, well, look, the problem comes from a faulty market design. This notion of marginal cost pricing is false, and we should replace that by something else, and that will give us better pricing. So as an economist, you look at that and you say, no, at the end of the day, the revenue from the energy market are going to cover the total cost of producing the megawatt hour, the variable cost and the fixed cost. Whether you want to do pay as you bid, whether you want to do marginal cost pricing, whether you want to run factorial auctions, Japanese auction, Dutch auction, you do whatever you want to do. At the end of the day, the pot of money going to the generators has to be the same to cover the cost. Otherwise, they will not invest in the future. And if you don't give them confidence that they will cover the cost, they will not invest, and we have problems. So in that case, my minister is saying something that's completely off. So it happens everywhere. The Italian minister is doing the same, and the Spanish economic minister is doing the same, and so on and so forth. And it's happening. Now, why do they do that? Because I think politicians feel very, and that's mostly a European and North American thing. I don't know how it is in Brazil, but in Europe and North America, politicians feel that markets have betrayed the people after the 2008 financial crisis. Because when you look at the 2008 financial crisis, and I'm going to be a bit thought-provoking here, but I think it's fair. The bankers bankrupted everyone, and they left, and nobody got to jail. If you are sitting on the street, if you're losing your job, if you lost your house because of the subprime crisis, you did nothing wrong. You bought a house, you lost it, you were living in the street, you lost your job because the economy contracted, and no one got punished for that. I mean, you see, it seems unfair. And if you're a person in the street, you see that, you're very upset. If you're a politician, you understand that people are upset and you share their concerns. So I think by and large, politicians have lost their faith, whatever faith they had in the ability of markets to deliver the stuff. So what's our ally? At least in Europe, it's the bureaucracy. In Europe, the European Union is telling the politicians, we hear your concerns about your customers' bills. We're going to relax the rules that you can give them all the rebates you want on the taxes, on the this and the this and the that, but don't you come near marginal cost pricing. So the bureaucracy is actually holding the fort by telling the politicians, we understand what you're saying, we understand people are hurting and you want to give them money, so those are the tools, the ways you can do it. But the core architecture of marginal cost pricing and the single market in Europe, we're not going to touch. So that has worked in Europe. And I think what you need to have is a robust bureaucracy that can withstand the political pressure. But again, it may work in some countries and may not work in other countries. And, thanks God for the judges in the US, right?
Thank you, Professor. Well, the more you speak, the more I'm convinced that we go back to the influence of the word power. Right, and then trying to make the connection with the second category, we're running short in time already. The second bundle of questions that we are receiving is kind of defying one of your statements when you said that we really shouldn't care about what customers want or think. And I understand what you meant, and I mean no disrespect, I completely understood the meaning of your statement. Especially if we separate customers into those who really know how to process information and make good decisions, large customers or that operate in the wholesale market, and retail customers. I'm very honest, I really don't care as an individual about details of the regulation. I'm only interested in two things. Do I get electricity in a reliable fashion? And is my electricity tariff going up or down, right? However, if we go back to Steve Jobs, when he was creating the world-changing products that are part of our lives today, he actually said, if I listen to customers, I would never come up with the iPhone or with the iPad or with any of the other platforms and products that Apple presented to the world. So, inspired on those words, should we then just relax? That's true. The retail customers do not know and do not want to know about the details, but we should move on with the reforms. We should move on with innovations that are required in the electricity market. And having said that, if you look at lessons learned that you've seen on a global basis, and we know that you are also an expert in the Brazilian market, if you had to point one suggestion, one path that we have to follow, which is it for the next 2 or 3 years that we need to try to implement with a lot of emphasis?
That's a very good question. Before I try to answer that, let me just say a few words about the customers. I think you are absolutely right. The customers in practice do not care much. Most customers do not care much about beyond what you just said. Is the power on? Is my bill going up or down? That's for 90% of the customers, that's all they care about. The challenge we have is that customers are also voters. And as customers, they don't care, but as voters, you want them to be on board precisely to deal with the politicians, to go back to your previous conversation and to the previous conversation. So if I had suggestions, my personal view, and I'll make 2 suggestions if I may. One is we need, as an industry, we need to find a way to make electricity somehow sexy for the citizens and for the voters, and somehow it has to be with it being green. It has to be with it being an answer to the global warming crisis. It has to be with. I don't have the answer to that, but I think there is something about making sure that the people around us have a stake in what we're doing with the power industry. One example, which may not be the right one, in California, Tesla, and again, it may apply only to a very limited market, but I think it's relevant. You know, you can have your electric car, you can have a Tesla wall, you can have solar panels on your roof, and somehow you have to be pretty wealthy to do that. And I'm not saying it would apply to everyone, but somehow you're part of the electricity solution, because with your solar panel generate electricity, your Tesla wall, you store it, with your electric car, you can balance the system. So somehow, one thing we need to strive is to create opportunities for people to be involved in the power system. That's the one. The second one is we need to strive to make the rules simple. I mean, sometimes I look at the rules and I don't understand them, and I need people to explain them to me 5 times before I understand them. And my guess is if it's that hard, if there are only 5 people in any given country who understand the rules, you know, it's just going to be bad, right? Because the politicians are going to get confused. And as engineers, and I'm also an engineer by training, we need to strive for simplicity. And when it gets to be too complex, that you need a PhD in operations research to understand the rules, we need to step and say, wow, are we solving the right problem here? Can we simplify it?
Okay. Thank you so much, Professor.
You're very welcome.
We're really running out of time here.
It was a pleasure.
Appreciate again for your contribution, and thought-provoking presentation. Thank you very much.
Thank you.
Eu peço desculpas à audiência, a gente realmente está estourando o tempo aqui em mais de 10 minutos. Precisamos fazer o intervalo, então passo para o Cláudio. Obrigado.